demystifying with that voice. That was pretty good. We actually have a quartet here. They're first going to sing an intro. This is awesome. So we're excited to be here. We've got a great panel. So we're going to start off by first letting our panelists introduce themselves, tell us a little bit about what you do at your companies and what your companies do. And then also, I'm curious to hear a little bit about what excites you about the space right now. And before I turn it over to him, I think we'll probably just go Rob down the line. We've got Rob Loban, who's the Chief Accounting Officer at Gemini. Got Ed Reginelli, who's the CFO at BitGo. Markus Veith, who's an assurance partner at Grant Thornton. And Brian Carson, who's the controller at CleanSpark. So Rob, go ahead, take it away. And he's got a fan club.
All right, awesome. Thanks for that intro. So I'm Rob Loban. I'm really excited to be here. I think there's a lot of energy, particularly in the accounting community, which is odd for me to say that accountants actually have something interesting to talk about, particularly with the backdrop of everything that's been happening. Oftentimes we're sort of forgotten, and what we do isn't really front and foremost for the business, but I think when it comes to Bitcoin and crypto, it is extremely important, so I'm excited to be here.
Great. My name is Ed Reginelli. I am the Chief Financial Officer at BitGo. BitGo is a qualified custodian and technology platform. Our main core product is our wallet services technology, which is driven by multi-sig. On top of that, we operate a prime brokerage business, including our trading and lending products. We also offer our clients the ability to stake out of cold storage. So we're connected to all the leading validators in the industry. And then last year, we were really excited to announce we came out with a new product called Go Network, which is a settlement and payment platform. The company is 11 years old. I've had the opportunity to be with the company for 4. So it's been a really exciting time. We've been through a lot. I've known Rob for a while. And we've both been through hell, and what's the old saying, don't stop. So we kind of got through it, and it's exciting to kind of see where the industry is at today. I am super optimistic about what's going on and excited to be here today. So thank you.
Good morning. First of all, thanks for coming out this early on Friday. I know it's going to be an interesting conference. So I'm Markus Veith. I'm a partner and the national industry leader for blockchain and digital asset practice. Grant Thornton is a traditional accounting firm. We offer audit, tax, and advisory services. We've been in the digital asset space since 2014, and I'm really optimistic about the movement we're seeing and hopeful that we're going to see regulatory clarity, that like a framework is put in place, that all that's happening, regulation by enforcement, standard setting by regulators, that comes to an end and we have like clarity that the industry can thrive and develop.
Yeah, my name is Brian Carson, and I'm the Director of Finance for CleanSpark, America's Bitcoin miner. And I'm relatively new to all things Bitcoin. About 2 years ago, Gary Vecchiarelli, our CFO, reached out to me and had a compelling offer to join the CleanSpark. And he talked about Bitcoin and what it's going to do for everything over the next century or millennium. He talked about CleanSpark and their growth plan. When I first started, we've grown now. We were at 4 exahash. We're at 20 now. So definitely high growth, great company. And he talked about the leadership there, even going up to the founders, Zach and Matt, and then Gary, the vision they had. So definitely one of the best decisions I've ever made in my career to join with CleanSpark. And I can't tell you how excited I am to just be in this space, especially with this new accounting guidance that came out that really does create so much more transparency for all holders of Bitcoin. So
let's start the conversation where you just alluded to, Brian, which is new accounting guidance recently came out. So the Financial Accounting Standards Board last December issued a new ASU, an accounting standard update, that officially moved U.S. GAAP from the old intangible asset impairment, cost less impairment model to a fair value model. And rarely has accounting, to your point, Rob, been this front and center in the industry. And it's something that had been waited for a very long time. As somebody who used to work at the FASB, it was fascinating to see how quickly this project happened in a very compressed period of time, considering their heavy diligence process. But I want to kick it off, Brian, and you guys early adopted the standard. You were one of the first movers. Get your perspective on how is this impacting the market? What has the reception been? And how do you see it driving adoption going forward as well?
Yeah, well, I'll tell you this. When that standard was released, there was a collective cheer from all miners, especially CleanSpark, when that came out. I mean, it's been anticipated for a while. The accounting for Bitcoin and intangibles, indefinite lives lived intangibles, really wasn't meant for a Bitcoin. But that's where it fit in. And for those out there who can I just give a quick example
Please.
of how the prior accounting worked? So being an indefinite lived intangible, as a miner, let me give you the example. Say you mined a Bitcoin when the price was at 65,000. The prior guidance would say, okay, you test it for impairment when indicators happen, and so when price fluctuates in Bitcoin, and it does, let's say the next month it drops to 50,000 just for a spike, and then goes right back up. Well, the prior guidance would say, okay, well, where it touched the bottom, the 50,000, that's what you're going to mark all your Bitcoin at from that point forward, never reversing that loss, even if Bitcoin just jumped up an hour later. So balance sheets were just not really reflective of the true value that these companies had. Now, smart investors, obviously, they did their math. They knew if you held this much coin, they knew how much Bitcoin you had. But what this did is it just creates so much more transparency for all companies that hold Bitcoin across industries or anyone who holds Bitcoin. You know what the value is. It's going to be based on fair value. So that's the new guidance. And the great thing with Bitcoin being so readily traded, it's a level 1 fair value. So the measurement is really easy. You can verify that. So it simplified the accounting immensely. It created so much more transparency for the readers and investors. And, that's one of the things. So CleanSpark, we're a September year-end. A lot of companies are December year-ends. And when this came out, we had just filed our 10K. So we were not able to early adopt. You really can adopt it all the way back to your first quarter of the year that you adopt it. Well, we had already released, so we adopted it on effective October 2023 in our first quarter. And other companies that came out, they actually were able to adopt it as of January 2023, but they had not released their financials. So we were the first ones to go out with the disclosure, which, that adds a lot of excitement in the accounting realm, which, yes, it's true. There is some exciting stuff in the accounting realm as far as making sure we get it right. When you're the first one to go out, you don't get kudos. You have to get it right. So we brought in the right people to help us and look at the disclosures and how we adopted it. So it was great.
It's interesting to hear you mention how the balance sheet was not a really good depiction of what the entities owned. There was a misalignment. I mean, the purpose of accounting is to be an accurate depiction of economic realities of a business operations, and in that case they weren't. But it was also the income statement, because you had impairment expense weighing down on the income statement and no ability to write that back up and essentially reverse out an impairment expense, which created a lot of pain for people. So, Ed, I want to pull you in here, and as you've thought about the pains that you've experienced with impairment in the past and looking forward into the future, how are you anticipating this play out for BitGo?
Right. So we are a privately held company, so we don't have public reporting responsibilities. But to kind of just add on to what Brian said, from a selfish standpoint, it just made the back office a lot easier. It was such a pain point to be able to track individual transactions and look at impairment for every transaction. Because if you're a company that has one or two transactions, kind of easy. We have thousands and thousands of transactions per day that you really have to kind of dig into, subject it to impairment, track that basis then in a first in, first out as you're moving through inventory. It was incredibly difficult to manage, which then leads to mistakes. And it's a very, very manual process. Systems weren't really set up to manage this, and that's why I appreciate companies like TaxBit who specialize in putting systems together that can help track this. But an incredibly positive move in the industry to move to fair value. We also run a lending book, and our lending book is roughly a flat book, so we borrow an asset and re-lend it. And the accounting was even more punitive there because the asset was being treated, as Brian explained, under this lower of cost or market, where the liability was being marked to fair value. So it created another massive mismatch on the balance sheet, and incredibly confusing for investors, for counterparties, assessing your balance sheet of what's really going on. So I was very, very excited when this guidance came into place in December. We early adopted back to January 1st. And again, it's just much simpler, and I think it gives a better perspective of a company's position.
So for folks listening, mandatory adoption of the new guidance is required at the end of this year. So fiscal periods beginning after December 15th this year, you have to apply this new guidance. And it's important to prepare for that. Make sure that you have the procedures, processes, systems in place to support new disclosure requirements. To your point, Brian, these have never been required before. So make sure that that can be a smooth transition process for you, and it can be a huge benefit to your organization. So marching on here, there have been some good things that have been happening. There's also been continued challenges in the space. I think recently we've been hearing more and more about SAB 121. It's kind of resurfaced in the industry for a number of reasons. We had Congress essentially vote to remove it. We had the president veto that bill. We've had some other recent reporting around SAB 121. Rob, I want to turn it over to you and maybe help us understand, what is SAB 121? What impact does it have on custodians? And why is it getting so much attention?
Yeah, I mean, it's great for us to start off with the good, and unfortunately I'm going to have to deliver the bad in terms of the reality that we live in right now. And I'll maybe start with how the FASB came about with the standard and how the SEC came about with the standard. The FASB listened to everyone. They took comments, they read them all, they categorized them, and they would admit the standard is not perfect, but it was responsive to the majority of investors, users, preparers, accounting firms. The standard came out, which is why a lot of us are really excited about that standard because it got fair value, made our life a lot easier. It's not perfect, but it's there. It's a great beginning part. The SEC, if I put it in contrast, came out with Statement of Accounting Bulletin 121. They did not ask anyone for feedback ahead of time. They essentially dropped it on companies in Q1 of 2022. If you're public, you immediately had to adopt. I think you probably had a few days, literally before the end of the year, that you had to accommodate it. And let's be honest, you see the consequences on this. The good thing about SAB 121 is it's the only thing that's united Congress. Both houses in Congress, the majority of them voted to repeal it. The bad thing about SAB 121, unfortunately, the president vetoed it. We're still stuck with it. And why is it so bad? It's bad because if you're in a company like BitGo or Gemini or really anyone that's touching customer funds, SAB 121 essentially says we're going to look through all legal form, all precedent, all existing gap that exists for any other industry, and we're going to have you put it on the balance sheet. Seems easy enough, and why was the reason for that? They wanted disclosure. They thought people wanted to see disclosure, and I'll be the first to admit, when they actually released SAB 121, I naively was happy because I was like, yes, we're getting something. We're getting there. I've completely changed my mind, and I hope the SEC changed their mind as well, and I think they're getting a lot of comments behind the scenes about it. And so what does it really mean for the industry at large? You could look at SAB 121 and say it only impacts public companies because it's written from the SEC. Unfortunately, if you operate in a regulated financial services-like environment, which a lot of components of crypto operated in, Gemini, we're a New York DFS regulated custodian. We also have licenses in a variety of states. We have a variety of legal entities across the U.S. doing various things. When you look at your compliance with those regulators, they generally default to SEC rules. And so while you might be a private company, you are de facto backed into an SEC reporting requirement that does not make any sense. You are also backed into now bringing this on balance sheet, which you then have to report and fit into regulatory reports, which means you're going to have to hold more capital for it. And it's just sort of nonsensical. And again, I go back to, like, look at how the standard came out. It came out sort of in the, I don't know, I'd like to say the dark of midnight, and was sort of dropped on everyone, no feedback, we're all reacting to it. This is why you see now that Congress is almost unanimously saying let's overturn it. You're also, unfortunately or fortunately, hearing behind the scenes that people are now trying to pre-clear with the SEC to have their own individual facts and circumstances be exempt. You know, I'm all for people pushing forward their business, but it seems a little bit inappropriate for the SEC to be spending so much time outside of the public view working one by one with certain custodians or others to say you're exempt and you're not exempt versus just repealing the rule and let's start over from scratch.
It's interesting when you think about the incredible success that the ETFs have had recently. You have traditional custodians that are essentially boxed out of that business. And there's some major FOMO going on because in order to custody these crypto assets, you have to put them on your balance sheet, which increases the reserve requirements that you have to hold, but you do not get credit for the assets you are custodying to satisfy those increased reserve requirements. That's why custodians, traditional custodians, banks, have been unable to act as custodial partners in the most successful ETF launches in the history of ETFs. So you can imagine how that rubs them the wrong way and puts a lot of pressure on the SEC, Congress, and others to try to get this changed. There's a lot going on in the regulatory world. And Markus, I want to bring you in here. You sit on what is the AICPA's Digital Asset Working Group. So this is the American Institute of Certified Public Accountants. And you guys have a lot of work that you're doing behind the scenes to promote, I think, you know, some good common sense accounting, both practitioner and auditor practices. Maybe you could share a little bit about the work that you're doing there and some of what you're seeing on the regulatory front.
Aaron. So the AICPA has a working group, digital asset working group, that was formed a couple of years ago, right? When there was like no guidance, there was no FASB guidance inside, just to get practitioners from various accounting firms and industry together to develop Practice 8. The first Practice 8 came out a couple of years ago, and it, you know, suggested accounting and auditing guidance. But what makes what can make life difficult at the time when the FASB said, look, I think it was like just 2 or 3 years ago, they said, oh, crypto is not prevalent. We're not gonna pick it up. But then things evolved quickly. Fortunately, now we have a standard. So the AICPA has developed a Practice 8, but there's always the risk that, you know, regulators like the SEC or FASB could overturn it because, you know, the AICPA is an accounting standard, it's not the authoritative guidance. One example is crypto lending, right? So there was guidance in the AICPA Practice 8 that basically said you lend out a crypto asset, you don't de-recognize it, and then the SEC came out and said, no, it should be treated differently. You recognize loan as an asset, and you have to put an allowance against it, right? There's just one example where you do work, but then you have to be careful who's the ultimate standard setter and who makes the decisions, right? And that's what's also driving a lot of the thought process among accounting firms, right? Because you don't have a lot of clarity in specific areas. Accounting firms are conservative and careful by nature, right? So there's a lot going on that companies then tell their clients, well, we don't have a clear answer, pre-clear with the SEC, right? So I don't know how much is in the pipeline of the SEC, but I know there's been a lot of pre-clears going on. It's like on a case-by-case basis, and of course, right, each case is company-specific, individual, right? But it kind of like clocks down the SEC process, slows down the process from accounting firms getting comfortable, right? A company wants to go public, and the accounting firm says, well, you know, here's a specific topic, we want you to pre-clear. Of course, that slows down that process, and I'm excited that now we have a FASB standard on fair value of digital asset. It's a starting point, right? They also scoped out a lot of items, right? NFTs are scoped out and certain other assets. But I think the thought process was, look, let's get the basics done, that we have a starting point, and then we can add on to that. But the AICPA, right, just getting back to the working group, you have like all the top minds from the large firms involved, practitioners, right? I'm also involved with the stablecoin reserve attestation work. We're developing a practice. The mining aid is about to come out, and then you consult with the practitioners, right? Companies that issue stablecoins, or in the mining space with mining companies, right? So it's a big effort to loop everybody in to have sensible guidance and recommendations.
So a lot going on in the regulatory world. Some positive progress. Some progress yet to be made. We'll keep working on that. Let's shift gears for a second and let's talk about accounting operations. Companies have to deal with this at the end of the day. The good, the bad, and the ugly. They got to deal with it. So, Brian, let's start with you and just kind of walk our way back down the line here. The question is, like, what is the most painful part of your accounting operations today? And what are some things that you have found to be helpful in addressing and minimizing those pain points?
Yeah, so a little bit of a story when I first joined on with CleanSpark. As I mentioned, I was new to Bitcoin and the accounting. So accounting is accounting. The same standards everyone has are the same. But I walked into to talk to my controller, and I just said, okay, just walk me through how we account for Bitcoin. It's a fungible asset. I was like, just walk me through the details of this. And we opened up this spreadsheet that was tracking all these lots of mining dates and tracking costs of when it was, and then was it impaired, and then you're tracking this new cost, and then does it get further impaired, and then we're on a FIFO basis, so the first coin that you mine, that's going to be the first one you sell. And so I walked through this spreadsheet and I said, oh my, this is the craziest thing I've ever seen. So clearly the first thing we really had to do, and we've been doing that, is we started using software that helps us to account for that. Back in the day when we were smaller, before our 5 times growth, maybe the spreadsheet, we were able to do it. We had some controls around it. We had very strong controls on it. But still, we had to get it systemized. So get it into a system that will be able to allow us to track each individual Bitcoin and at its cost basis. Because even with the new guidance, everything gets marked to market at the end of each period, but there are still disclosures that require you to say, okay, if you sell a coin, you now have to disclose what was your realized gain. You don't separately disclose it. You don't separately display it on your income statement, but you do disclose it. And so you still have that tracking mechanism you need to keep to be able to manage each coin as it goes through.
And even from your tax returns. You got to get your corporate tax returns right.
Even more so there, yes. Absolutely. You got to have that system be able to track it and monitor it and know exactly what cost you're applying to these transactions. So really that's what I would say is the biggest, is make sure you're getting this stuff into a system so that you're not doing the brain damage, because the controls, you can have as many great controls as you want on a spreadsheet, but eventually you gotta step out of that and really get a more robust control structure on it.
Marcus, what do you see?
I think, just having been in the audit space for digital assets since 2014, right? We talked to a lot of startup enterprises, right? And the challenge is, right, again, accounting firms are conservative, right? We're not that quick movers as innovative companies at times, although we have to innovate our business too. So you deal oftentimes with entrepreneurs that are saying we're running a technology firm, right? I mean, I personally think if you handle other people's assets, money, right, there's got to be some guidelines, rules, and regulations. They have to be sensible, right? But everybody should know what they are and play by the rules and adhere to them. So just having to deal with the mindset of a technology company, right? You build a business that grows very, very quickly, right? You focus on running the business. Of course, that's what you want to do. But then, like, the accounting and the auditing and the controls are lacking, right? So over the years, we talked to many startup businesses that said, oh, we're getting a license, we need an audit, right? And then you do like a due diligence, and you realize, well, there's just not much there. They don't have enough people. They don't have the right people. Manual tracking, no tracking, right? So oftentimes, then you tell them, look, you don't need an audit. You need somebody helps to get ready for an audit, right? So it can be challenging if you then start to audit a company that's not really ready, right? So I think being ready, having the right people, accounting can be complicated, can be challenging, right? If you don't have it in-house, get a qualified accounting advisor who can help you adopt the fair value standard, deal with all the requirements and rules, and just make sure you have good controls in place.
Thank you. Ed, pain points. Like, you've been an operator for a long time now.
So 2 pain points, and it's kind of under the umbrella of regulatory friction. One being accounting firms, and the other one being Treasury. So if you kind of pull the thread on accounting firms, all accounting firms want to get involved in this space. It's exciting. They're learning, doing special projects and things like that they want to get involved in. But when you move to the next stage of that relationship and trying to get them to sign up to be your auditor, to issue an opinion, it is very difficult. And I'm not saying that you can't get it done, but if you kind of pick like the top 10 accounting firms, you're going to find some that are sort of leaning into the space and some that are running away from it outside of just doing advisory work. So I'll give a shout out to Grant Thornton. They help us out in a few of our audits. They're taking a deep dive into the space, and it's very, very helpful. With that being said, though, it's still very difficult to get through the onboarding process as a new client. So if you're normally expecting 30 to 60 days, you can probably double or triple that just because of the risk profile of companies in digital assets. Not that anybody's doing anything wrong. It's just firms have to probably take a look at that a little bit differently. So that's on the accounting side. On the Treasury side, you have to have backup banks for your backup banks for your backup banks. Like if you heard the term choke point 2.0, that's real. The large tier 1 banks, it's very difficult to get a relationship with those players. You have to look at the mid to small regional banks to partner with, and you have to do a very good job of diversifying your assets to multiple different banks. We lived through early 2023 where the industry's banks, Silvergate and Signature, disappeared overnight. So everybody was looking for their client funds, which you're holding on behalf as a custodian, looking for a home for that. In addition to that, your own treasury. It's not just the banks aren't turning you away because they don't like to work with client funds. It's your own treasury too, and it's incredibly important part of all of our business models is to have those on and off ramps. So the recommendation here is you have to always be constantly looking to add banks to your partners, and always be prepared that one day you could wake up, there could be some pressure from a federal agency on a specific bank, and they're going to push your assets out. So just always be thinking about that, and again, keep growing your list of banks you're working with, because there are some really good banks that, kind of like accounting firms, that are leaning into this space and are really good partners.
I love that you bring up the Treasury use case, because Treasury and accounting are so tightly connected to one another, often report up to the same, direct reports. And I think folks in the accounting seats, if you're a CPA, it's an opportunity for you to play a very strategic role in the company in being able to become an enabler of process, an enabler of strategy, an enabler of launching new initiatives. So Treasury's front and center there. That's awesome. Rob, pain points.
Yeah, I think you guys did a great job covering them. I think one thing to take for granted is when you're an accountant and you're in crypto, the base is basically gone. And so what do I mean by that? Well, crypto trades 8 decimal places. There's not a single off-the-shelf system you can get that can handle that many decimal places. That's a small thing. That just creates racks, problems, things like that. You wouldn't even think about it until you start to go through it, and you're going to end up just having a lot more sort of junk to come through. Another thing, as I said, the crypto standard, great movement, but it's still an intangible. So what does that mean? That means if you have covenants with banks, you have debt covenants, you have covenant with anybody you're even just a partnership agreement with, probably has a net worth requirement in it. And you need to be really careful if people are negotiating those terms and salespeople that they're paying attention to the fact, how are we going to treat crypto? Because somebody could look at it and say, oh, it's an intangible, you're violating your net worth requirement. You could be sitting on, hundreds and hundreds of millions of excess capital, but because of that one requirement, you might look like you're underwater. That's going to have some bad consequences. And normally as accountants, you don't really think about that, but you've also got to get in front of those folks. The third thing is, I think with all of us, it's gotten a lot better, but it's also just, communicating up to other folks on the C-level and boards and others about like what it actually means to do your job. There are a lot of people that might come from other industries, from a SaaS industry, and jump into this and think like, hey, I know what it's like to run an accounting team. You only need X number of people, and all these problems really mean you need a lot of bodies, you need a lot of software. Unfortunately, it's a lot more expensive. You've got to get auditors, you've got to get advisors. It's also a challenge for you just to get ahead of, like, get the budget ahead of time so you can have those resources, because ultimately if you don't have it, you're going to be held accountable, and your job is to really tell that bad news to others as early as possible to make sure you can smooth the way going forward and report on time.
Well said. Very well said. I think we've got time for one more question here. So the four of you collectively represent a lot of knowledge. Many of the vanguards of the accounting industry and crypto are right here. So if you were to maybe give some advice to yourself when you were first entering into the space, as we watch adoption curve continue to mature, more people join, more institutional enterprise, like folks who are sophisticated getting into the space. What advice would you have given to yourself getting in? We'll kind of do this as rapid fire and then wrap up here. And I'm going to start, Rob, with you, and we'll go reverse order.
Well, I think one of the reasons I really like being in this space is how connected everyone is. There's generally, I have not met a single person up here at could be a competing organization who's not willing to pick up a phone and talk. So I think the really important thing is from day one is just ask people questions. No one really knows. Everybody's trying to figure it out. Pretty quickly I figured that out, and I think that's been a success factor, is just asking and figuring out what's going on.
I kind of look at it in three ways. Like, what was important for me when I got into the space, if I was getting into a brand new, not knowing anything about digital asset accounting, you have to find a mentor. So I was fortunate. The audit partner, when I first joined the company, was with Deloitte. He kind of really walked me through this incredibly complex accounting. So that was very helpful to me to find that mentor, the expert in the space. And as Rob mentioned, secondly, the network effect. Even though sometimes, in some cases, we're competitors, we all help each other out. We talked about fair value accounting. That was not something that just came up last month. It was something that started probably 3 to 4 years ago. And it was all of us in the industry participating, working with the SEC, working with AICPA task force, working with each other, trying to figure that out. So networking in this space is incredibly important. And then third, document the hell out of everything you do in this space. We're all highly regulated, and the regulators expect it. So whatever accounting policy you have in place, make sure you document it. I guarantee you're never going to regret having really good documentation. So those would be my 3 recommendations: is get a mentor, network, and then let's document.
I just want to add on here on the regulatory side, right? From my perspective and advice to businesses, I mean, we did the same thing, right? Make sure you have a good relationship with your regulator. I mean, sometimes it can be frustrating, right? Like well-known cases, like some of the big exchange players have regular interaction with the SEC. The next day, right? One day they have a meeting, the next day they get a Wells notice out of the blue, right? Still, they're a regulator. You got to keep a positive relationship, stay close to them. What we've done over the years, right, we're also looking to educate the public. Regulators want to talk to us. I mean, we went and talked to like a number of regulators. Some invited them, others, we offered to speak to them, right, just to educate the public what it is, how accounting works, how you can audit it, right? Like if you all work together, that just helps to educate. Because what I've noticed, like 8 years ago, the regulators really, right, the DFS was suddenly charged of supervising crypto businesses, right? And most of their folks were just like banking or insurance folks. They just didn't know how it worked. So I remember sitting in meetings with them, right? participating in like a regulatory exam. They were more interested in learning how it works and how you can get your hands around it, because they were like suddenly charged overnight to regulate and supervise something. And the other aspect is really networking. Have a good network with people you can pick up the phone and call if there's questions, right? Because we're all together in this. If you all work together, then positive things will come from it.
I think those were all really well said, and something I definitely would implement. One thing I can add to that is get your butt out of your seat and go to the operations as well. Not just on the accounting front, but get out there and see it in action. So that's one thing I did not. I did that on the accounting front, did the walkthroughs, but I really wish I would have got out to the sites, to our mining sites, to talk to operations folks, to really look at their systems and everything else, because that really would have cemented a lot of my knowledge earlier. But that's actually the most exciting thing about the Bitcoin mining is actually going out to the sites and seeing how they work and feeling the miners. It's the most incredible thing. So that's all I'd add on, is just get out there.
I'm going to ask you for a tour later.
All right, you got
it. So, great advice, really sound advice. Hopefully everyone was taking careful notes of those things. So I want to thank all of our panelists. The substance of this has been really, really good. So thank you all very, very much. I'm confident this is very helpful for folks, so we appreciate it and hope everybody enjoys the rest of the conference.
Thank you, Aaron.